Ever wondered why some investors lose money while others continue to profit? It's a question that has likely crossed your mind. The world of investing is filled with stories of fortunes made and fortunes lost. Even the most seasoned investors can find themselves on the losing end of a deal. This isn't due to a lack of effort or intelligence, but often the result of a variety of factors that can trip up even the most experienced among us. Over the course of this video, we'll be discussing the key reasons investors lose money, from a lack of knowledge to emotional decision-making, lack of diversification, poor money management, and even a lack of patience. These pitfalls are common, yet they are also avoidable. Understanding these factors and how they impact your investments is crucial to your success. So, buckle up and join us as we delve into the various pitfalls that investors frequently encounter. The first reason investors lose money is a lack of knowledge. Imagine sailing a ship without a compass, or driving a car without a map. That's what investing without proper understanding of the market, the asset, or the economic climate is like. It's a risky venture that can lead to financial loss. Think about it. Would you invest in a product you know nothing about? Would you put your hard-earned money into a company without researching its track record, its competitors, its strengths and weaknesses? The same principle applies to investing. Investing is not a game of chance. It's a strategic move that requires research, education, and a thorough understanding of the market. It's about making informed decisions based on facts, figures, and trends. It's about understanding the economic climate and how it can affect your investment. And yet, many investors skip this crucial step, plunging headfirst into the investing pool without testing the waters first. Without the right knowledge, an investor is navigating blind. Another common pitfall is emotional decision-making. This is when our emotions, such as fear or greed, take the wheel and steer us into making hasty, often regrettable investment decisions. Imagine the stock market takes a dip, and fear kicks in, prompting you to sell off your shares hastily. Or perhaps the market is booming, and greed entices you to buy more than you can reasonably afford. Both scenarios can lead to significant losses. The antidote to emotional investing? A level head and data-driven decisions. Instead of reacting to market fluctuations with fear or greed, consider the cold, hard numbers. Research the companies you're invested in. Understand the market trends. Make decisions based on facts, not feelings. The world of investing is not for the faint-hearted. It is a game of patience, strategy, and calculated risks. Emotions can cloud our judgment, leading to poor decision-making. Remember, emotions have no place in investing. The third reason investors lose money is a lack of diversification. Now imagine this. You're at a carnival, standing before a dartboard. You have 5 darts. Would you throw all 5 at the same spot or spread them out, aiming for different areas? The latter, right? That's diversification in a nutshell. When you put all your money into one investment, you're betting everything on one outcome. It's like putting all your eggs in one basket. But what happens if that basket falls? You lose everything. This is where diversification can be a lifesaver. By spreading your investments across different assets, you're not only increasing your chances of success, but also reducing your risk. Think of it as a safety net. If one investment doesn't perform well, the others might compensate for that loss. It's a strategy not just for the rich and experienced, but for everyone who wants to safeguard their hard-earned money. Diversification is the key to mitigating risk. Poor money management is another reason why investors lose money. It's like setting sail on a vast ocean without a compass or a map. Without a clear financial plan, the ship of investment can easily drift off course and sink. One of the biggest missteps is not setting a budget. A budget is your financial blueprint. It outlines your income and expenses, helping you understand how much you can afford to invest. Not tracking expenses is another pitfall. Every dollar you spend is a dollar less you have to invest. Keeping tabs on where your money goes can help optimize your investment capital. Lastly, not having a clear investment strategy can lead to financial loss. Investing isn't a game of chance, it's a game of strategy and discipline. You need to know what you're investing in, why you're investing in it, and when to exit. In the end, just remember this. Proper money management is crucial to successful investing. The final reason we'll discuss today is a lack of patience. Investing isn't a sprint, it's a marathon. It's a long-term game where the players who hold their nerve often come out on top. Those who are impatient may find themselves making hasty decisions, selling off their investments at the slightest hint of a downturn, or jumping on the latest investment fad without adequate research. This impatience can lead to potential losses, as they may miss out on the long-term growth of their investments or buy into a bubble that is about to burst. Patience allows you to ride out the inevitable ups and downs of the market, to wait for your investments to mature, and to seize opportunities when they present themselves. It's not about timing the market, it's about time in the market. The most successful investors understand this, and exercise patience as a key part of their strategy. Remember, patience is a virtue, especially in investing. So, what have we learned today? We've journeyed through the labyrinth of investment pitfalls, and in doing so, we've unearthed some key lessons. Firstly, the importance of knowledge cannot be overstated. A well-informed investor is a successful investor. Remember, knowledge is power. We also discussed the danger of emotional decision-making. The market can be a roller coaster, but it's crucial to keep a level head, making decisions based on facts, not feelings. Next, we touched on the importance of diversification. Putting all your eggs in one basket? Not a good idea. Diversification can be your safety net in this high-wire act of investing. We then explored the concept of good money management. It's not just about making money, it's about keeping it, growing it. Finally, we learned about the value of patience. Rome wasn't built in a day, and neither is a robust investment portfolio. By avoiding these pitfalls, you can increase your chances of becoming a successful investor.